Hi, Martin. Welcome to Venture with Grace.
Hi, Grace. Nice to see you again.
Okay, so to start the show, I would love to for the audience to get to know you a little bit more. So honestly, like from my binging through the podcasts we've been on, like you invest in Google. I know it's like through Ron Conway's found, but yeah, like I was like, wow, that's like such a big accomplishment in life. Um, Maybe let's start with like your entrepreneurial journey, and then maybe how you got involved with the Ron Conway Fund, and then like maybe we could go from there.
Sure. Well, if we go all the way back, I've kind of been an entrepreneur like from the beginning. When I was 6 years old, we lived in a house that was near in Gainesville, Florida, near the University of Florida.
Mhm,
And we were near the stadium where the football games were on Sunday.
mhm.
And down the street from us, there was a parking lot where everybody parked, and then they all walked down the street in front of our house.
Mhm.
And I'm standing there one day and I was like, there's a lot of people there. I wonder if I could make money off them. And so I started a Kool-Aid stand on Sundays and made a giant pile of money. And it was because I wanted to buy this little radio. Anyway,
Mhm.
I've kind of always been an entrepreneur and thinking about ideas of, how to service people, how to invent things from when I was 6 years old. And when I was in college, I studied computer science, but a lot of my friends at the time, this was in the late 80s, and they were doing technical computer things like device drivers for keyboards and stuff like that. And I was always interested in the business applications of technology. So I was using Excel to write spreadsheets to trade stocks and solve business problems. And I've always been really intrigued with the people who solve business problems
Mhm.
with technology as opposed to purely technical problems. And that's why when I left college, I went to Anderson Consulting, which is a computer company, helping businesses with technology. And then I went to Microsoft. And when I left Microsoft, I started my first company called Loud Eye Technologies, and that was doing a service provider for streaming media. We put up the first sort of clips library to sell songs. We created some of the back end for Napster and things like that. And I've always been in this area of, how does technology make your life better? And I was three times a venture funded CEO, and I've been investing in companies for about 30 years as an angel. I did about 250 deals before I started my venture fund about 5 years ago. And the reason I started a venture fund 5 years ago is that I was kind of done being a CEO. It was the middle of the pandemic, and I didn't know what kind of company I would start during the pandemic. So I said,
Mhm.
maybe I'll just write checks
Mhm.
because that's probably easier than figuring out what kind of companies would be successful during the pandemic. And in the last 5 years, I've been really looking for more of those B2B software ideas. Kind of like the quintessential example is when I was at Ignition, we led the Series A of DocuSign. And DocuSign is software that solves a business problem, how to sign a contract. There's a horizontal solution. Lots of people have lots of different contracts, millions of contracts a day type of thing. And I went looking for more of those. I've done 75 investments in the last sort of 5 years. Six of them were unicorns, two of them were decacorns. And I just really like it. That's how I got into investing is, just focusing on business solutions that solve friction at scale.
Mm. Totally. I mean, I guess like I want to ask oh, by the way, I want to say hi to the audience. Hi, Peter. Okay. So, you have like run your own company and then you have like been a venture partner somewhere and then starting your own fund. Um, I wonder, so like number one is like, what are some stuff that you're always be learning that you feel like is like crucial to be an investor? And then also, I feel like as an angel investor and running a fund is like super different. Like angel, like sometimes it's like kind of like a vibe check. Like you sense that this founder is like a great
Yeah.
technical talent or like salesperson, and they can close the next round. That's kind of the thinking framework sometimes. But on the other hand, there's like the portfolio construction, the thinking about if you do full on or not, and then fundraising and everything else. So I
Yeah.
wonder what were something that you were actively learning that you feel like this journey kind of like from angel to emerging manager kind of surprised you?
Well, one thing that I did, when I started this is I did a bunch of data analysis. Before I started the fund, I had done 250 angel investments. And I was an LP at the time in 12 funds. And I looked at my total returns of the funds. I was doing about 2.4x TVPI. My angel investments were about 6.5x. So I looked at that and I said, I'm better as a direct investor than an LP, so maybe I'll do more of that. Then the second question was, so the first thing, I always look at data for everything. The first thing is, okay, I'm better, I make a higher return investing directly than as an LP, so let me do more of that. And the second question is, okay, what kind of companies am I really good at investing in? I looked at the whole 250 companies, and when I was an angel, when you're an angel, you're like, you meet a guy and you're like, oh, he's smart. He seems like he's doing something good. Here's $25,000. Good luck, right? And I was knocking off $25,000 checks, and I didn't really have a thesis. I didn't have any follow-on strategy. I didn't have any portfolio construction. I was just donking off checks. And I went through all 250 of them, and I said, where did I have an opinion? Where did I have some value add? Which ones worked really well? Where did I get lucky? For example, I invested in this company that was creating hydrogen for fuel, and I got lucky and it became a unicorn. But I was like, I don't think I can replicate luck. And what I did when I sort of analyzed all the investments is I said, you know what? Where I had a thesis that this guy was onto something, where I had some business development connections that could potentially help them, where I had some follow-on investors that could potentially help them, those on average did better. So let me look for more of those. So I went from a generalist thesis. When you're an angel, you're generally a generalist. You're like any good deal. And I said, well, okay, but deals that I've done that are B2B software, reducing friction at scale, those have tended to do better as a group. Let me look for more of those. So the first thing I did is I constrained my thesis to ones where historically that I had done well. I went looking for more like that. And then the second thing I did difference between angel and being a venture capitalist. So as an angel, I was donking off $25,000 checks. And if you talk to Peter Walker at Carta, the average pre-seed round of $1 million, the average check is $25,000 because it's mostly angels. And I decided to write a $250,000 check. So what I had to do if I was going to write a 10 times the average check size into that round is I had to say, what's my framework to get to a higher level of conviction? I have to get to a 10 times higher level of conviction than an angel does. So what do I do? So the first thing, I have a couple of frameworks that I use as a VC that I don't use that did not use as an angel. As an angel, you're typically writing the check, moving on to the next deal, and doing almost nothing for that company. As a pre-seed VC, your number one job is to get that fucking founder the next round done, like to get follow-on financing. You're almost never creating a profitable company in pre-seed, so you have to really think about who is the next investor. So the number one thing I do differently is I think about 3 potential follow-on investors who will take a meeting, who write seed or Series A type checks, that I know what their thesis are. I know their check size. I know the kind of team they're looking for. And I make a list of at least 3, sometimes it's more like 10. And I say, these are the people I'm going to call. And I know them because I do regular calls. I have like 30 calls a month with later stage VCs, and I'm just catching up and sharing portfolios with them. And this is something I didn't do as an angel, have regular calls with follow-on investors. But I'm tracking what's going on in the market, because the key thing you need to do different as a pre-seed VC is to know the size of the round, know the traction metrics they're trying to get to, and know that traction, if they make it, is going to unlock more financing, and who are those financing people you're going to call. So the first thing I do is I look for 3 follow-on financing people. I know what their traction metrics are. I write down their names. And then I track the company and I keep those VCs updated. And then when they want to raise more money, everybody's sort of primed to take the call. The primary thing you do different as a VC is you have a little bit more of a constrained thesis versus an angel, and you think about value add, and whether that's follow-on financing. Some VCs are about hiring, some VCs are about venture, business development. My primary value add is follow-on financing.
I wonder, so like you mentioned about like these like 30 calls. How like what's the I guess like what's the cadence? Like do you have like a running list of like let's say 200 of them and then you follow on with like let's say 30 here, 30 here. And
I have a list of about 60 and I talk to them once every 2 months.
Are they like in particular sectors or like how do you kind of like construct this
No, they are VCs who lead seed or Series A in B2B software. So it's people like Index, Tiger, Andreessen Horowitz, some seed funds like Slow Ventures and SOS and Sussa Ventures and RE Ventures, people like that.
I wonder, do you like let's say for passing on a deal, do you chat with the analyst, a partner, or like it's like a mix of both? Since I feel like in different firms there's like different
It's almost always the partner. I mean, I'm the partner. I don't talk to analysts.
I feel like sometimes analysts are like a lot more informative and like or like on the ground they are like more eager to like build up their own track record than like just like
That's true.
people who are on top. Um, just out of curiosity, on like, so when you're running these like 30 minutes conversation, I guess like obviously there will be some sort of like catching up, yada yada yada. But like, how do you like strategically run it to like either push your portfolio on like into their radar, or like do you have prepared some sort of like summary, be like, oh hey, here's like 30 things I've seen. Do you
No, it's not.
or
Well, typically it's just hey, what have you invested in lately? And if you're doing a 2 month cadence, chances are I've written at least one new check since I talked to you last time. And it's not generally about what are you seeing, because, for example, I get 300 pitches a month and I write maybe one check. So I don't talk about the 299 that I passed on or the ones that I'm in diligence on, because that doesn't fucking matter. What matters is, where did you write the fucking check? And so I say, here are the last one or two checks that I've written. And then they say, here are the last one or two checks that we've written and what we're looking for. It's typically around the portfolio that you've actually committed to.
Do you personally, I guess, like, what does your personal CRM look like? So, for example, let's say, do you write notes on like literally keeping track of like what this guy said or that person said
Yes, I
update, or
use a note taker called Rome Research, which is kind of like Notion or Obsidian. And I like it because it has backlinks. And every time I have a call with them, if and for every firm I have and every partner I have like a summary thesis, like what do they invest in, and if they update that, I'll update that, and then I have notes, and I can look back at all the notes that I use Rome. I don't use a CRM. I don't like CRMs. I use a note taker.
I guess, like, do you go back to the notes? Like, I know it sounds like so much, but I feel like I'm a nerd, so I'm curious about how other people do it. But okay, so what are things that you will look for in the notes? Because sometimes I feel like, oh my God, I wrote down so much like non-necessary detail about certain things. But I guess like
Well,
what are the core things that you would go back to look?
mostly it's like, what else they have invested in, or did we talk about another company? When is the last time? Like, for example, I got sent a referral from a VC that I work with a lot today, and they said, have you talked to this company, Finecto? And so I go into my notes, I look for Finecto, and I'm like, oh yeah, I got an email from them before, and I talked to so and so, and then I can respond to that email much better, because I was like, yeah, here is the 3 times that I've already talked to them, and I'm going to catch up with them or not. The other thing I have done recently, with notes. I do take some notes myself during a meeting, but I have a note taker in most of my calls, and I have a script that automatically copies the transcript and the summary from those note takers into my notes too. So I have the full AI summary of every meeting I've ever done, which their notes are actually even better than mine. So
Mhm. What note taker do you use? Or do you use like a Zapier to like connect your rum research to the
I use
thing?
Zapier to connect Sybil, which is my note taker,
Mhm.
to Rome.
Got it.
And I've tried all the note takers. I mean, they're all getting better and over time. Um, I've tried 6 or 7, and the one I like right now is Sybil. Sybil.ai.
Mm. Hi LinkedIn user. So okay, so I want to like so basically okay, so after you have, let's say after you chat with a 300 founder in this month, and then I guess like the other
Well,
probably of like
I don't talk to 300 founders. I get
yeah,
300 pitches
DMs or yeah,
in,
yeah.
in my form. So
Mhm,
one of the other things that I've done for as a pre-seed professional pre-seed versus an angel. In an angel, when I was doing angel investing, I was getting 20 or 30 pitches a month, and you can deal with that in email. With 300, you just can't deal with emails. So I have an AI bot that
mhm,
automatically responds to cold pitches in my email and tells people to go to a form. So I
mhm,
try to get everybody to go to this structured form. It's an Airtable link, and in that Airtable link, I have some structured logic that
mhm,
checks it against my thesis. What stage are you? How much are you raising? How many co-founders do you have? Are you crypto? Are you CPG? Are you all these categories I don't invest in? And of that 300, roughly 60% of them are automatically screened out by the logic in my form because they're just simply not a fit. They're too late, they're too early, they're crypto, they're CPG, they're
mhm,
something I don't invest in. And I have an automation that automatically responds and tells them no.
mm,
And of the remaining about 40%, then I look through them and I have some scoring logic. I have an AI reader that automatically compares like the deck against my thesis and it scores the company. And it actually does a pretty good job. The top sort of 10% of those remaining 60% are companies that are a super tight fit for my thesis. And
mhm.
those are the companies where I actually do read the deck and decide whether I want to take a meeting. Of those 300, I take approximately 20 meetings in a month, and I start diligence on 2 companies, basically.
Mm. So okay, you're saying 300 DAC into the forum and then 60% out. That's kind of a, I don't know, like we're at like 140 or what's the vibe there? Like, and
Yeah,
then
yeah, about
after
140
that,
left.
and then so basically you're saying after everything else, like after the AI screen, everything else, you maybe have like 30 in the profile and then you actually diligence two. Is that, do you talk to the 30 or do you just like go straight into the two company that it's
I
like,
talk to approximately 20 in a month.
okay.
I will
Um,
read. See, the problem is it takes, founders don't like to hear this, but VCs spend approximately, and you can get this from DocSend, approximately 2 minutes reading a deck.
mm.
If I had to spend 2 minutes times 300, I would be doing nothing but reading decks. It's
Two
just
2 minutes is very generous. I feel like whenever I'm
even
seeing
that, right?
yeah, exactly. It's like 30 seconds, and then you see the docs after the team page you're gone.
Exactly. So I read approximately 60 of the
Mhm,
decks. So
mhm,
that's 2 hours, 120 minutes.
mhm,
And then from there I pick 20 to
mm,
take a meeting with.
mm.
And I'll do
Hi
a half-hour intro meeting.
mm. Hi, LinkedIn user. Okay, so, I guess, like, when you're actually on these meetings, like okay, so another question about this is, like, okay, you also have to do the fund I don't know if you have, like, a fund admin or, like, you have to do it yourself, like or the fundraising side. I think, like, previously, prior to, like, this thing, we briefly chatted about, like, fundraising as well. I guess, like, how do you construct your time? Because I feel like, as a solo GP, it's, like, half of your time is, like, racing or, like, even maybe 100% time to race for, like, the a few months or so. Um, how do you think about?
Yeah, in the beginning, it's 100%. I mean, fundraising goes, first of all, VCs are always fundraising. Even if their
Mhm,
current fund is closed, they're going to have a next fund in 3 months or six
mhm.
months. So, um, you know, it goes in cycles. I am at the end of my fundraising, so I don't spend that much time on it right now.
Congrats.
Hmm? Yeah, I'm
Congrats.
spending most of my time on, deal flow. It's kind of most of the time it's probably 50% new deals, meeting companies, probably 25% portfolio support, and 25% talking to LPs. When you're doing a new fund, it can be like 80% fundraising and 10% new companies. It just depends on the time. Like for example, I'll be raising a new fund starting in Q1 of next year, and for Q1, I'll probably spend 70% of my time talking to LPs versus companies. The other thing is I have a much lower percentage of time spent on portfolio support because I don't take board seats. For VCs that have board seats, they would have a higher percentage of time on portfolio support. And
Mm,
I don't do a lot of fund admin. I mean, basically any VC, any solo VC now is probably using one of the platforms like Decile Group, like Ihar and I do, or Carta or AngelList, and they do 90% of the fund admin. There's just not a
mm,
lot to do there.
hi, LinkedIn user. Okay, so hi, another LinkedIn user. I don't know US names because of like I guess
I got
today
it.
our signal did not come through. But anyway, okay. So basically you're saying like fun like okay, so another question is like after let's say I think we probably chat about this, but like for let's say for the LPs, like I think you mentioned about like, you yourself is a big LP, and then obviously you have some rich friends because you run successful companies. And how do you think about like the people that who go after like tiny small checks for like 1,000 times versus the one that just to try to go after like top cut like top 10 anchor that
For
just like
LPs.
yeah, yeah.
Well, I talked to a lot of other managers that are trying to raise
Mhm.
funds, and the reality, my experience is for your fund one, for your first fund, I hope you have a lot of rich friends because those are the only people who are going to invest. And if you have, a normal VC fund, you are limited to, well, if you're under $10 million, you might have 250, but if you're over $10 million, you have a limit of 99
Right.
LPs. So the problem is that you can't take people for $1,000.
Mhm.
You have to take people with the minimum in my fund is $250,000. I
Mhm.
have 52 LPs now.
Mhm.
And the vast majority of them are people that I already knew before I started the fund or friends of the friends that I did already know. The reality for a fund one is that it's going to be your first close is going. My first close was $4 million, and it was all people that I already knew.
Mm.
You're not going to get fund of funds in that close. You're not going to get family offices. You're not going to get people who don't know you. For fund two, with a track record, you might get more people who don't know you and look at the statistics and so on. The other strategy, if you do have a lot of friends who might want smaller checks,
Mhm.
a common strategy for fund ones, and a friend of mine has done this, is to on AngelList create a parallel fund
Mhm.
with a lower minimum because AngelList can have a minimum of like $1,000.
Mhm.
So if you are the kind of person that has a lot of smaller investors, you might consider doing a parallel fund.
Mm. I heard about that too. So like it's like yeah, you can create two I
You
guess like
create two funds, and when
yeah.
you write $100,000 check, maybe you write 70,000 from your main fund and 30,000 from the parallel fund. The
Mhm.
parallel fund invests in exactly the same thing that you invest in on a pro rata basis. But like in an angel list fund, there's no limit to the number of LPs you can have.
I feel like that must means like whenever it's like when you're filing like tax returns and stuff, it's like gonna be a pain.
Uh, well, in that case, AngelList handles all the K1s and the tax and everything for you, so it's
Mm,
not that much of a pain. I mean, it's not
mm.
free; you have to pay management fees, but um,
What does it actually look like when you're like hiring a law firm and like using Angelus? Like, because I hear different things. So some people say like, let's say you got a lawyer that's like 75K already gone. But I also hear people that just like literally have paid $0 on lawyer fee, just use everything on Angelus.
you
Just out of
know,
curiosity.
for Fund One, I would recommend that every manager use one of these full service
Mhm,
fund managers where the LPA is included and all tax and everything. And that includes AngelList, Carta, or Decile Group.
mhm,
I would not recommend going out and hiring service providers to do the
mhm,
different things because you're just going to pay 2 or 3 times as much. And
mhm,
these guys all have very optimized workflows, and you can just use their thing. What you give up in that case is the ability to modify the LPA because it's a standard LPA, for example. But that's completely fine. I don't think you should be doing custom LPA terms in a $10 million fund. I recommend everybody with Fund One use a full service fund admin like those three.
How much does those charge? Like
Uh,
25K?
it depends, but in general, it's maybe 40 or 50 thousand dollars total to start your fund. That includes all the entity setups, the three different entities, the LPA, everything. And then they charge, $20,000 a year or something like that for fund admin. They're all very similar.
Mhm,
The most cost effective one is probably Decile Group,
mhm.
um, but I haven't compared them recently.
Mm. And that another thing is like, okay, so when people are thinking about like the management fee, that's like, 2% of 20 years slash 2 million, and then you front load, I guess like 3% or something first 3 years. And then I guess like do you just literally take out like is this like an automated process to like actually send the money to you as a fund manager in the system, or like
No, no.
you
Well,
manually do it?
no, you have to do that yourself. So what happens is that you make a capital call. For
Hmm.
example, in my case, I've done so far two capital calls of
Hmm.
25% each. If you have a small fund, you're probably doing less frequent larger capital calls versus a big fund. They might do a 5% call and then 3 months later another five. They might do small calls, but in a small fund, you probably want to do big calls. And then what you do is you get that money in, and then it's up to you to know how much you have available to invest versus management fees. And then typically what you would do is just move the management fee money into a holding account and then pay that to yourself over
Every time, every capital call. So I
every
thought it was
capital call. You just take the percent that's management fees and put it in a separate account, and then you pay your management expenses. In a small fund like that, you have to pay employees, you have to pay your
mhm,
software and all of that stuff. But you have to pay attention to it and know, because one of the problems small funds can get into is knowing how much money they have to make investments versus management fees or
mm,
versus expenses. And hopefully your back end software, like I use Decile Group, it's actually got some pretty good tools to predict that, to say, you should expect this year to have expenses of this, management fees and tax and all this other things. And so make sure you reserve that money. I have seen a lot of managers get in trouble where they maybe over invested their money, you know, and didn't have enough there to handle fund expenses.
mhm.
So hopefully your whoever you're using for fund admin has a good planning tool to help you do that because it's
That's
on you to manage the money.
Wow, that's actually crazy. I mean, I always heard about like people have fun admin, but that sounds like that's actually gonna be like really expensive too. So it's like a full-time employee, like the CFO of your fund, assuming.
Well,
And then there's like the
One of the good things about venture capital lately, like when I first was working in venture capital, I was a venture partner at Ignition,
Mhm,
and they were a traditional venture fund, but they had to hire 100% of their own back office to
mhm,
run the fund. They had a CFO, they had two accountants, they had this huge infrastructure to do all the admin.
mhm,
But today, as a solo manager like me, like Ihar and these other guys,
mhm,
the back office managers, they'll run everything for you. So
mhm,
it's expensive, $20,000 a year, but $20,000 a year is not expensive when you consider you're replacing like three full-time employees.
mhm, mhm, mhm.
Right? They
True.
have huge staffs that are
Mhm,
that are doing that work. It's
mhm,
actually um, a lot easier now. One of the reasons there's a lot more venture funds today is because they don't have to do all of that back end office
mhm,
admin. The platforms like Carta and Decile and
mhm,
AngelList have really made it very easy to manage the details of a venture fund. That's why there's more of them.
mm. Hi, Charles. Charles wants you to be his mentor. But
I,
so okay, so I wonder, when you're thinking about, I guess okay, so we talk about like okay, another question for you is like, I feel like inbound deals typically are not as quality as, like, the one that you really go after, but who do you really go after? Like, and I'm sure, like, the LPs ask you about, like, what's your deal funnel look like? I mean, obviously, you have a really big presence on, like, Twitter and stuff, but, I guess, like, what are your how do you, like, professionalize or, like, um, institutionalize your funnel?
Yeah, well, one way I wrote a lot of software, and
Mhm,
you're right. The cold inbound is a higher noise to signal ratio,
mhm,
but all that means is that you want to have better software to help you filter that noise
mhm,
from the signal. If I look at my 300 deals, approximately 200 are cold and approximately 100 are from referrals from other VCs. So it's two-thirds, one-third. If I look at the checks that I wrote, it's exactly the opposite. Two-thirds go to referrals and one-third go to cold inbound. So I am investing in a lower percentage of my cold inbound than I am my warm referrals, which you would
mhm,
expect. But I still want the cold inbound. What you've got to do as a solo VC is figure out a way to be efficient at
mhm,
sorting through those. That's why I have the logic in the Airtable, the automated deck reader, the AI thesis,
mhm,
checker and stuff like that. So to
mhm,
professionalize it, you have to write a lot of software. There are some companies I've seen that are trying to provide that software as a service to VCs. Most of them are really, really fucking bad. But I would love if somebody else wrote that. The
mhm,
problem with most of those, like there's another deck analyzer, a general deck analyzer called deckdrop.io.
mhm,
And you can upload a deck and it'll give you a diligence report like a VC would. The problem is it's generic and it's
mhm,
not specific to your thesis. So it
mhm,
won't work for most VCs because it's just, is this generally a good startup? If you're a generalist VC and you don't care, you don't have a specific thesis, then maybe that's okay. But
mhm,
most of the tools you need to automate your workflow have to be personalized to your specific thesis. If
mhm,
you're a generalist, maybe it doesn't, but um, most VCs have, even if they say, one of the reasons I started doing a lot more on Twitter is
mhm,
that, most VC websites are, we love great founders. And every founder is like, I'm a great founder. Those two things don't help narrow the focus. Because the reality is, even VCs that says we love great founders, they have something in the back of their mind of what they think a great founder is and what
mhm,
sectors and stuff like that.
mhm,
And they're trying to keep their top of the funnel as wide as possible. But that doesn't actually help founders find the right VC for them, which is
mhm,
why on Twitter I talk very specifically
mhm,
about my thesis, the verticals and stuff like that. Because what
mhm,
I'm literally trying to do is help more founders that are aligned with my thesis find me. That's what I'm trying to do. I'm trying
mm,
to reduce the noise in the signal.
mm. Um, Love that. But, like, okay, so do you have, like I know that you built a lot of software and stuff like that, but, like, And then for the people who refer you, like who are these other people? Is that like angel investors, or I'm sure it's like kind of
It's
quote unquote
everything.
everyone,
It's
but like
angel investors. It's employees I used to work for. It's other managers. I mean,
Mhm,
one of the things I like about pre-seed is the normal sort of $1.5 million pre-seed round is typically two or three funds like mine writing a
mhm,
$250 or $500,000 check and a bunch of angels. So they're almost all party rounds. Nobody has the sharp elbows out trying to push everybody around. So
mhm,
if you're committing to something, you are interested in sharing it. For example, I just led the pre-seed in this company called Newell AI, which is a supply chain AI out of Purdue.
mhm,
And the first thing I did after I wrote a $250,000 check is I sent it to like 10 of my other VC friends because they
mhm.
wanted to raise like another $500,000. So, you're incented to share in the pre-seed.
Mm. Uh, but I think the other thing is like, how do you automate the process of like sending it to like 100 of your friends? Because like obviously you mentioned like you do that once a month, like you invest in a company once a month or
Yeah.
something like that.
I
But
don't send it to 100. I send it to 5 to 10.
right, but like the problem is like I think um the take rate, it's like a different story, right? So like I mean like when you send to 5 people, everyone's like, yeah, I'll think about it, I'll look at it, like I mean because they like you or like because they're your friends or something. But in the end of the day, like that company had to like close someone. And how do you like, I guess, like actively tracking the process? Another thing is like, okay, after you invest in them and then the founder is kind of gone, like they're not gone, like they send you like, I don't know, quarterly newsletter about their updates, and like they're trying to hire like 5 engineers, ask you to post about it on Twitter. But besides that, like how do you actively track these stuff? Do they have to fill out some stuff in your like, do you have like a program for that, or like how do you track the investments?
No, I don't have a good way to track whether people take meetings and stuff like that. But I tend to have a much higher sort of acceptance rate. I do have tools that help me do these warm intros. For
Mhm,
example, I have a list of referral VCs. When I send the intros, it pre-writes a bunch of these warm intro mails for me, and I send them to the founder and the person automatically. I don't have a thing that closes a loop and knows whether they have a meeting, but I get a very high rate, like an 80 or 90% meeting rate on referrals that I make, mostly because the only referrals I make are companies that I've already invested in. I
mhm,
think if I do get referrals sometimes from VCs that are like, we're looking at this and we might do it. And I'm like, okay, but I don't really fucking care. What I care about is, did you write the check and are they raising more money? And those are the only referrals I make, which is why I think I do know I have a very high acceptance rate for when I send to other managers because I'm like, I already wrote the check,
mhm.
right?
uh Another question for you. What's a conviction to write a check? So like earlier stage, there's obviously people shooting for, I don't know, 100 uh 100K MRR, or like what's a vibe? Like so, or like do you, I know that you talk about this on another podcast about like, there's like pedigree founders like trying to raise some money, but they tell you that they only need like 6 week of runway or something like that, like something crazy, or like, oh, we'll raise like a bigger round later, but right now we only need this amount to survive, blah 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 blah. Um, okay, so first question, pedigrees, like so like the big tech employees. So I don't know, like like top 40% from like OpenAI or something, or like let's say the second category maybe like the schools, like the MIT, Stanford, blah blah blah, and then the third pillar would be like I guess like I don't know what is the third pillar. I guess I mean I evaluate them based on like can they sell, can they story tell slash
Right.
that kind of stuff. But
Those
what
first
are
two
the
categories have traditionally been signals that a lot of VCs look at. I don't look at those. I don't give a shit where you worked. I don't give a shit where you went to school. What I care about is founder market fit
Mhm,
and momentum. and also I care about the size of your round. The number one mistake in pre-seed investing is not giving the company enough money. Until about 2 years ago, I was okay investing in a round that gave a company 12 months worth of runway. But that's because you could raise money reliably every 6 months. It was ZERP, everybody was dunking off checks, it was fine. The problem now is that we're not in ZERP, we're in a much more constrained environment. So for pre-seed, I'm only investing in rounds that are providing 18 to 24 months of runway. I had a company come to me last month and it's like, oh, we're raising 6 months of runway because we're going to raise it 3 months from now. And I'm like, you're fucking crazy. That's not the environment we're in right now. I'm not going to do that round. I don't care how good you are. So I want to see a founder with great founder market fit. I want to see, I think it's more important to have 2 or 3 founders than one founder who went to MIT and used to work at Meta. Frankly, I've found people that were working at big tech and went to fancy schools. Most of them that I have looked at have underperformed because they were not used to startup and scrappiness. I'd much rather see a founder that's solving a personal problem that is super scrappy than a guy who went to a fancy school.
I wonder, so like, what if the founder is like a major hustler and like obviously did a lot that like, you're impressed basically, but their product idea is shit. Like, how do you think about that? Like, obviously, I feel at the
Well,
very beginning they can change later, but like,
well, I mean, something like 60% of my companies have pivoted. And, that's normal. I do want to have some belief in what they're building first, even if they do end up pivoting. If it's a good team and a bad idea, I still pass. I want to have a good team and a good idea. That they may pivot, but I don't want the idea to be bad from the beginning.
okay.
I won't invest just in a team. The other thing is my definition of pre-seed. People. It's funny. Founders are like, so and so raised a $5 million pre-seed with no product, and I'm like, yeah, that's because he created a unicorn before and all of this other stuff. Like, you're not that guy. I only invest in pre-seed companies that have already built an MVP. I think there's a stage before pre-seed, which is called angel, where you're raising under $500,000, where if you've got an idea, you raise a little bit of money to build an MVP, you get a few customers, and then you do your pre-seed. There are VCs who think pre-seed is a guy with an idea. That's not what I think pre-seed is. I think pre-seed is a guy who had an idea, built a prototype, sold it to some customer, and now wants to scale it. That's my definition of pre-seed.
Wow, dude, what? I'm sorry. That's well, I do feel like this is like a very like wide range of like how people thinking about stuff.
There is a wide range, and different VCs have different opinions, which is why I talk about what my opinion is. Because if you're pitching me, that's what matters. It doesn't matter what the industry thinks or what any other VC thinks. What matters is what does Martin think if you're going to pitch me.
Right. So like, what's the ownership are you targeting?
I mean, I'm a small check. I mean, I'm at $250,000. The average valuation for companies that I invested in the last 2 years is $8 million. So I'm getting about 2.5 or 3% for my $250,000.
How do you stay? I mean, I think it's like a location driven question because like I feel like living in Silicon Valley, everything is more expensive to a
Yeah.
degree because of the cost of living is also super
Yep.
expensive. And like so I guess like for that it's probably like very different from Seattle, from like somewhere else. How do you think about like sourcing in different geo? And obviously
Well, I source all over the world. I tend to stay away from the main tech hubs like Silicon Valley because there's frankly no lack of funding in Silicon Valley. And if you're in Silicon Valley, on average, your company is going to have a much higher expense rate. Plus, you're going to have a lot more sources of capital. So there's no advantage for me in Silicon Valley. I have invested in companies in Silicon Valley. The last company I invested in, they actually were in New Zealand, and I invested in them when they were in New Zealand. Then they moved to Silicon Valley. So now they're in Silicon Valley, but they started somewhere else. I actually think if you look at, I mean, Silicon Valley is still Silicon Valley. It's got the giant, valuation creation. But if you look at the percentage of unicorns and the percentage of valuation that's being created around the world, Silicon Valley is shrinking in a total. It's still the largest bubble, but there's more value being created outside Silicon Valley than ever before. And every year, the value outside Silicon Valley grows as a percentage of the total. So personally, I'm looking for people that are doing things outside of Silicon Valley. I actually love funding. I funded a company, a second-time founder in Sri Lanka, and he is competing against companies in Silicon Valley, but he's, paying engineers $20,000 in Sri Lanka instead of $300,000 in Silicon Valley. I love funding the guy who's writing a similar thing as a Silicon Valley company, but has a expense ratio of 10%. That's going to be potentially, much better.
Another question is like, so for example, for the Sri Lanka guy, I think the problem is like, how do you diligence people overseas? Because obviously everyone can look legit with the
I went to Sri Lanka and went surfing with him.
Are you kidding me? Really?
No.
Is this coming out of the fund like administration budget, or like what's the vibe?
No, I like to surf, so I just went the fuck over there and surfed.
That's crazy. Wow, that diligence process is legit.
So, hey, when he said he was in Sri Lanka, I was like, I've always wanted to surf in Sri Lanka. I'll see you next week. And I just got on a plane and flew the fuck over there.
Okay, so did you check out his company? Does he have a company, like an office or something?
He does, but I'm being a little cheeky. One of the reasons I did that is that he created his prior company was the largest telehealth company in Sri Lanka, and he was funded by Elizabeth Yen at Hustle Fund. And Elizabeth knew him. And so, I mean, he was fairly qualified prior, a second-time founder. So I knew, that he was a qualified guy before I got on the plane to go to Sri
Lanka. That's a lot of more diligence than the. I mean, I feel like that's a lot of like
most VCs would not do that. You're right.
Oh no, I mean, I think the flying to Sri Lanka thing is like, interesting. But I guess like, how do you think about I mean, I don't think you can just like fly to every portfolio company.
No, you can't. I mean, that's an extreme example. There's another example. Like I invested in this company in Tanzania called Tembo Plus, and he found me on Twitter. He was a cold inbound, and I liked what he was building.
Question. I'm sure a lot of people would ask you, like, what should they say in the cold inbound? Like, because you mentioned about this other guy is like from cold inbound. So, okay, how do you?
Well, I mean, he went to my form and filled out the form, and his pitch
highly
quite highly. I read the deck. I wanted to take a meeting. I took the meeting. And I liked him, but again, he was in Tanzania. So the first question I had is, how do I diligence this guy in fucking Tanzania? Because there's no surf there, and I don't want to fly over there and go to Tanzania. So I called a friend of mine that's a VC in Nigeria, and he drove over to Tanzania and met the guy. So I had already another VC who I knew who was on the ground there. And so I called another VC who invests in fintech in Africa, and he said, oh, I want to talk to the guys. So I introduced the guy to two other VCs. Those other VCs had people on the ground, helped me do the legal due diligence, the family and all that stuff. And then the three of us put a round together and wrote him a check. So I brought in local VCs who could do the local diligence.
That's crazy. Wow. Oh my God. You have global, I guess.
Of course. But you have to. Otherwise, you're just, donking off checks with no diligence. I mean, that's what angels do. That's not what professional VCs should do.
But I think the other problem is like the geo is like so too it's a little too diverse, right? Like so I think like to scale uh in one region, I think like to put your bet in one region is and then that you're like living in or like super familiar with, it's like higher likelihood to like turn out to be something that's like not that bad. But like when you're like, let's say
I don't agree. I have a completely different opinion, but the localization. I talked to this guy yesterday. He lives in Greenfield or Greensburg, South Carolina. He has a small fund there. He's the only VC in town. He's like, I'm investing in everything in this town. I'm like, good for you. There's a guy here in Spokane that has a $4 million fund. He invests in everything in Spokane. I'm like, good for you. That's fine. And the geographic focus on VCs is great. The problem I have is that you are constraining yourself in terms of alpha, and you are not able to invest in the best founders anywhere in the world. My opinion is the alpha comes from finding great founders who can execute like crazy. And if you put a geographic constraint on them, you're artificially limiting your ability to find great founders. Because the reality is, I don't care how big your geography is. And if your geography is small, like Spokane or Greensboro, South Carolina, the probability that there's going to be a unicorn in that incredibly tiny geography that's like, market number 50 versus the, Silicon Valley and Boston and Seattle and all that stuff, you've stacked the deck against yourself. You might find companies that locally can be nice small businesses. You're very unlikely to find a unicorn. Very unlikely.
How do you think about the fund that only invests in like one geo or like one community? Like let's say
I think that's fine. We need funds like that. And I just do not believe, and the math proves it out, that those are the funds that end up being top decile returning performance funds. They might be okay as venture funds. You're never, that's not what Sequoia does. That's not what, Index. That's not what any of the top venture funds do.
For the 250 companies that you have invested in while in your like angel era, do you put in the exact same check size or no?
I did not. And that's one reason I started a fund, because one of the things that I did when I started this current fund is I went and looked at my total angel portfolio at the time, or in the same thesis, which was about 65 companies. And I had a variable check size. When you're when you're an angel, a lot of times your check size is based on how much money you have in the bank. So it could be $10,000, it could be 20, it could be 50, just whatever, right? And the problem with a variable check size is that, it's hard to predict which ones are going to be, great outliers. And, for example, one of the unicorns that I invested in, I only invested $10,000. So while it was a great multiple, it was much less than if I had a larger check. So anyway, before I started this fund, I went and looked at my 65 investments I'd done at the time. I had a variable check size between $10,000 and $150,000. The average check was 40. I had a TVPI at that time of about 2.8x and an IRR of about 28%, which is fine. But I said, okay, what if I had picked exactly the same companies, but instead written a standard $250,000 check? What would that be? Well, that would have been 8x TVPI and 112% IRR. So what that analyst told me is that I have good deal flow, I have good selection criteria. What I have to do is increase my average check size to $250,000. That's why I started the fund. Is now in this fund, my standard check is $250,000. So if I'm applying a larger check to a demonstrably good deal flow and selection criteria, on average, you're going to have a much better return. I think when I write every $250,000 check, everyone's going to be an outlier. The reality is they're not going to be. And the problem of varying your check size versus, conviction or whatever, is that you might be wrong. So
Mm.
it's a better strategy as a VC to write a standard check size across a disciplined deal flow and selection criteria, in my opinion.
Are you like, I guess like for the since like now your check says like 250K,
Yeah.
so you're investing, I don't know, like, so I guess like 30, 40 companies.
About 28 companies in this fund.
Okay. Um,
And I've done 16 so far.
so same check every company, and then
Yeah.
targeting ownership, like you mentioned, like single
3%.
digit. Yeah, yeah. Okay. What if certain companies' valuation is like significantly higher? You just pass or no?
Yes.
What's a cutoff line? Like a 10% or like, I don't know. No, sorry, not 10%, but 10 million valuation, or like, is there like a significant
I think
like?
the highest valuation I've done in pre-seed is 15.
Mhm. Okay, so that's still in the like normie range.
Yeah.
Like it's not bad. So what are, I guess like, oh sorry, I literally realized that we're about to hit the time, but like,
We
okay,
are.
maybe one last question and then 1 minute fire round maybe.
Thanks.
Okay, one last question is like, since like you have invested in so many founders at the very early stage, is there any tips for them in terms of like pitching? Because in their head, they're like also just like,
I, the number one tip I have for founders is do your research on the investor and see if you align. Have they ever invested in anything like you're building? Do they know anybody that you know? Get to know them. Don't just pitch them for money. Find a VC that has a high probability to align with what you're building. Most founders don't do that. They just pitch anybody anything, and it's not a good idea.
um, okay, 1 minute fire round. So what's your favorite book?
Meditations by Marcus Aurelius.
Who made the biggest impact in your career?
Probably Bill Gates. I used to work for him.
Who would you invite to your dinner party?
Invite to a dinner party? I'd love to have Trump at a dinner party.
Where can we find you outside work?
Can you find what?
Where outside of work?
Oh, sorry, you skipped out again.
Outside of work. So like, where can we find you
I'll find you
outside of
outside of
work?
work.
Yes.
Surfing or riding my bike.
Okay, wow, outdoor guy. But anyway, thank you so much, Martin, for coming on the show today. It was a fun conversation.
Thank you, Grace.
Let me quickly